Welcome to Market Brief After Hours. Today's session on Wall Street was a fascinating study in contrasts. We watched a remarkably sharp inflation surprise collide head-on with an unstoppable technology rally. Usually, hot inflation data throws cold water on the markets. But today, artificial intelligence and semiconductor momentum completely stole the spotlight.
It really was a tug of war today. On one side, you have undeniable, red-hot macroeconomic data pointing to steady inflation. On the other side, you have this relentless enthusiasm for long-term AI demand. Investors essentially looked at the rising energy prices and geopolitical tensions, shrugged, and decided to keep buying chip stocks.
Let's get right into those major indices because the numbers really tell the story of a divided market. The Dow Jones Industrial Average actually slipped today, falling 0.14% to close at 49,693. That reflects investors pulling back from economically sensitive sectors like financials and retail. But the S&P 500 and the Nasdaq? A completely different reality.
Absolutely. The S&P 500 pushed through the noise, gaining 0.58% to close at a fresh all-time high of 7,444. And the Nasdaq Composite was the real star, advancing 1.2% to finish at another record close of 26,402. Those numbers are rounded to the nearest whole number, but the percentage gains show a clear trend. The broader market breadth was actually quite weak, but semiconductor and AI-related shares just dragged the indices higher. Nvidia rose more than 2%, Micron Technology climbed over 4%, and the VanEck Semiconductor ETF advanced 2%. The sentiment in tech got an extra boost with Nvidia's CEO and other top tech executives joining President Donald Trump during his visit to China.
That geopolitical angle is definitely playing a role, especially with Asian markets trading mixed ahead of the Trump-Xi summit. But let's pivot to the elephant in the room, wholesale inflation. This report was significantly hotter than expected, surging to its highest level since 2022.
The inflation data is impossible to ignore. Producer prices rose 1.4% in April alone. To put that in perspective, expectations were for just a 0.5% increase. It's the largest monthly rise we've seen since March 2022. On top of that, March's reading was revised higher to 0.7%. When you look at the annual wholesale inflation, it has accelerated to 6%, which is the highest level since December 2022.
What is driving this sudden acceleration? Is it isolated, or are we seeing a broad-based surge?
It is becoming increasingly broad-based, which is the major concern. Energy is the primary culprit right now. Final demand energy surged 7.8%, and gasoline prices specifically jumped an incredible 15.6% during the month. But it's bleeding into other areas. Core PPI, which excludes volatile food and energy, climbed 1% against forecasts of 0.4%. Services inflation accelerated 1.2%. Trade services rose 2.7%, and machinery and equipment wholesaling margins climbed 3.5%. This tells us that price pressures are strengthening across the entire U.S. economy.
And this is having an immediate impact on the bond market and Federal Reserve expectations. Treasury yields spiked today.
They certainly did. The 10-year Treasury yield climbed as high as 4.49%, its highest level since July of last year. The 30-year Treasury bond yield even briefly crossed above 5.05%. The market is realizing that the Federal Reserve will have a very hard time justifying any near-term rate cuts with wholesale inflation running this hot. Adding to the policy shift, investors are digesting the news that Kevin Warsh has been confirmed by the Senate as the next Federal Reserve Chair, replacing Jerome Powell. That is sparking intense debate about the future direction of monetary policy.
Let's cross the Atlantic and look at the European markets, which rebounded today despite some rather grim economic data and rising political pressure.
It was a surprisingly strong session for European equities. The Pan-European Stocks 600 rose 0.7%. Looking at individual countries, Germany's DAX climbed 0.6%, Italy's FTSE MIB surged 1.0%, Switzerland's SMI gained 0.71%, and France's CAC 40 added 0.3%. Even the UK's FTSE 100 rose 0.31%, which is notable given the intensifying political uncertainty there. Prime Minister Keir Starmer is rejecting calls to resign following weak local election results and multiple ministerial resignations.
The market performance in Europe seems completely disconnected from the actual economic growth numbers we received.
The disconnect is glaring. Euro area GDP growth slowed sharply to just 0.8% year-over-year in the first quarter, down from 1.2%. Higher energy costs tied to the Middle East conflict are heavily weighing on activity. Germany's growth slowed to 0.3%, France eased to 1.1%, and Italy slowed to 0.7%. Ireland's economy actually contracted by a massive 6.3%. Meanwhile, inflation remains a headache. France saw inflation accelerate to 2.2% as energy prices surged, while its unemployment climbed to 8.1%, the highest since the pandemic. Portugal's inflation accelerated to 3.3%, staying well above the European Central Bank's 2% target.
We are going to take a quick interval here. When we come back, we will dive into the foreign exchange markets, look at the technical moving averages, and break down today's biggest individual market movers. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the macroeconomic landscape and the major indices. Now, let's look at the currency markets. The US dollar had an interesting session against major pairs. Let's start with the euro against the dollar.
Euro USD experienced a slight pullback today, closing at 1.1709, which is down 0.25%. The pair traded between a high of 1.1742 and a low of 1.1695. Sellers really took control after the pair repeatedly failed to break through the 1.1800 region. From a technical standpoint, the moving averages are telling a fascinating story. The pair finished exactly on its 100-day simple moving average at 1.1709. It is still holding above the 200-day SMA at 1.1682 and the 50-day SMA at 1.1646. As long as it holds above those lower averages, the broader technical setup remains constructive. Immediate support is right there at 1.1695, followed by that 200-day moving average.
How did the British pound fare against the dollar?
GBP USD closed down 0.14% at 1.3523. It had a session high of 1.3551 and dropped as low of 1.3485. However, buyers stepped in to defend a crucial technical level. The pair recovered from its intraday lows right at the 100-day SMA, which sits at 1.3484. It is also sitting comfortably above the 50-day SMA at 1.3431 and the 200-day SMA at 1.3425. If the pound can hold above that 100-day average, the bullish bias stays intact. Resistance is currently at today's high of 1.3551.
And looking at the Japanese yen, we saw a continuation of a recent recovery for the dollar.
Yes, USD JPY closed up 0.17% at 157.89. The pair is bouncing back from a recent sharp drop toward the 155.00 level. Right now, buyers are pushing it up to test the 50-day SMA at 158.69. It is maintaining solid support above the 100-day SMA at 157.36 and the 200-day SMA at 154.35. Bullish momentum is definitely rebuilding here. If we see a sustained move above that 50-day moving average at 158.69, it would heavily reinforce this recovery structure.
Let's shift to commodities. We saw oil prices ease slightly, with Brent crude falling around 2% to 105.63 as markets monitored negotiations involving Iran. But the precious metals market was split today. Gold struggled while silver surged.
Gold had a tough session, closing down 0.57% at $4,687. It traded between $4,727 and $4,670. The key takeaway here is that gold was rejected near key overhead resistance. It is currently stuck below both its 50-day SMA at $4,750 and its 100-day SMA at $4,780. It is still holding well above the long-term 200-day SMA at $4,310, but short-term momentum is definitely weakening.
But silver painted a completely different picture.
Silver was incredibly bullish today. It closed at $87.65, up 1.3%, hitting a session high of $89.37. Unlike gold, silver is trading very comfortably above all its key moving averages. The 100-day SMA is down at $80.67, the 50-day SMA is at $77.10, and the 200-day SMA is way down at $63.84. Buyers are firmly in control here following a breakout from a long consolidation phase, and the momentum suggests we could see further upside.
Finally, let's wrap up with today's market movers. There were some massive double-digit swings in individual stocks today. Ford Motor Company had a phenomenal day.
Ford surged more than 13% today. The catalyst was a note from Morgan Stanley suggesting that Ford could secure a massive energy storage system supply agreement. This would involve large commercial customers and hyperscalers over the coming months, which completely shifts how investors are viewing the company's future revenue streams.
We also saw big moves in the tech sector, specifically Nebius Group and Akamai Technologies.
Nebius Group rallied more than 15% after reporting a strong revenue beat. Their first quarter revenue came in at $399.0 million, comfortably beating analyst expectations of $391.6 million. Akamai Technologies climbed over 7% following an analyst upgrade. Bank of America Global Research upgraded the stock from neutral to buy and slapped a new $175 price target on it, which brought a lot of buyers off the sidelines.
But it wasn't all green screens today. Wix.com and Birkenstock took heavy losses.
Wix.com suffered a brutal drop, plunging more than 27%. They reported a first quarter adjusted gross margin of 66%, which missed analyst expectations of 67.8%. In this market environment, missing margin estimates is heavily punished. Birkenstock Holdings also had a rough day, falling more than 12% after reporting a second quarter operating profit of €155.5 million, which clearly disappointed investors.
It truly is a delicate phase for the markets right now. We have elevated inflation, rising Treasury yields, and geopolitical uncertainty all colliding with record equity valuations and aggressive positioning in the tech sector. It will be fascinating to see which side of this tug-of-war ultimately wins out.
The resilience of the tech sector is historic, but as inflation broadens into transportation and services, the macroeconomic reality will become harder and harder to ignore.
We will be tracking all of it as it unfolds. If you find this useful, please follow Market Brief After Hours.